Hey, what's going on, everyone? So, Mr. Donnelly again. I am doing more accounting work. This time we're looking at accounting for non-current assets. So, big focus on depreciation. Now, you can see by the sign, I thought, hey, I'm going to see you guys Wednesday, but probably not going to happen till Monday, but I put it in the form of a question mark. So, anyway, let's begin. Ow. What? Why? You know it was going to hurt. So, we're doing exercise 13.15 or 13.15. So that's on textbook page 372 and all these questions. So, a bit of theory, bit of prac. And then we'll be doing our answers on the workbook solutions. So I will provide a bigger view of those in a moment. But I think we'll start off by going through the question. So, accounting for non-current assets. On the 31st of October 2024, Rendell Clothing borrowed $25,000 from FCC Finance to purchase a new delivery van. On the same day, the business purchased a van paying cash. The van was advertised for $24,000 plus GST, but the owner bargained with the salesperson who agreed to provide the van and $500 worth of on-road cost for $24,200, which includes GST. Installation of heavy-duty suspension, that cost a further $900 plus GST, and the van had been insured for fire and theft with OOMY or UMI insurance at an annual cost of $4,800 plus GST. The van expected to have a useful life of 5 years, after which it can be traded in on a new one with a trade-in value of approximately $4,900. So, just so you know, while you're doing your work, I'll actually be working off on the book on the side. So that's how I'll just have two screens there. In the interim, we've got A, calculate the cost of the van, B, how we're treating certain items, C, the receipt of the loan and the cash purchases of the van, or cash purchase of the van, no narrations required. D, we're going to refer to an accounting assumption and explain why the entire cost of the van cannot be treated as an expense on the spot. E, calculate depreciation for the year straight line method. F, we're going to record the depreciation of the van in the general journal, still no narrations. Then we're going to talk about the qualitative characteristics for when we report depreciation. And then in July 2025, the delivery driver fell ill, so was not used for 2 months. Explain whether the van should be depreciated. So a lot of theory in there, and I think that's going to be good exam practice. So without further ado, let's tick over and make a start. So I'm just going to zoom that in. There we go. I'm just going to try and make that a touch bigger. Alright. And we're off. So we're going to do the cost of the van. Now, the cost of the van was $24,200 including GST. But that was only for the van and only including the $500 worth of on-road accessories. We've also got some additional add-ons. So we'll go van 24200 divided by 1.1 would give us 22,000. After that, we need to look at the heavy duty suspension, and that would be included. And that's 900. And after that, we've got the insurance. Now, we don't include the insurance. And I'll explain why in B. But essentially, we would include the suspension because it's going to make the vehicle more likely to be sold whereas, whereas the insurance is an expense. So if we put that together, we see that the total sum is 22900. Now we've got to put in our, why did we do this? So the insurance, suspension is included, and now this is B, referring to your parents or Part A, explaining your treatment. The suspension is included because it helps increase the value of the asset and gets the asset into a working condition for the business, because it takes costs extra to put the asset into working condition. Those extras need to be added on. Additionally, the business receives value for this. Now the insurance would not be included because this is an expense that is incurred, when each month passes. At the 1st October, this insurance is treated as a prepaid and is a current asset. Nice and simple. So that's how you would talk about it. You would not add this onto the van. You would not add this cost onto the purchase price cost of the van, because it's a prepaid asset that will be used up later on. So we now need to record these transactions. So we need to record the loan and the purchase of the van. So we'll start with bank and we'll go loan. Who was the FCC Finance? Now we know it's 25,000. It says in the question, and that means our bank goes up 25,000. Now the next transaction is the actual cost of buying the van. So we go van, and we know what the van is. It's 22900. 22900. Additionally, we also purchased insurance. So prepaid insurance, and that is 4900. And 4800. Why did I write 49? I think I wrote the residual value. So we see here that that's all done. So we go GST clearing, and we know that we paid for it by cash, so bank would go down. So let's get our trusty calculator out, because that works so well on the Monday lesson. 22900 plus 4800 equals, and then it gets $27,700, but we need to multiply by 0.1, and that gives us 10%, and that is our GST, so 2770. Then we just need to add on our numbers. So we go 2770 plus 27700 plus 4800, and that gives us, yep, I've put the wrong number in. We should have 4800 plus 2770 plus 22900. There we go. It should be 30,470. I mean, I could have just gone to 9 I should have just gone these two together, which was 2770, and then just added it in. That would have probably made a lot more sense, but hey, we got the answer in the end, so go us. Let's move to D. I'll just create a new page for D. So D. Referring to one accounting assumption, explain why the entire cost of the van cannot be treated as an expense in the year ended 30th of June 2025. And we're going to go with the period assumption. So remember, when we answer our theory questions, we always go to definition. What is the period assumption? So the period assumption states that an expense or asset, an expense is only incurred in the month that it is used in. Month or time period, we've got time period that it is used in. In this case, the whole asset has not been used up to the 30th of June. Jeez, my spelling is off tonight. 2025. Hence, it cannot be an asset. Is not an expense and must be treated as a non-current asset, as the asset is used more over time. Then the cost can be over time, then more of the cost of the van can be treated as an expense for its relevant month. So really laying it on thick there, but I think you get the idea. So let's move on to E. Calculate depreciation of van for the year ended 30th of June 2025 using the straight line method. So straight line method, so depreciation of van is cost minus residual over useful life multiplied by months over 12. So let's just get that there. So let's plug in our numbers. Let's got our cost, which was 22900. If you don't believe me, it is up here. 22900 minus the residual of 4,800. No, it was 4,900. Whoops, a daisy. 4,900 divided by the useful life. Which is 5 years, multiplied by the amount of months. So we're going to the end of June, so end of October, start of June. So let's just add that in there. So we're going from November onwards. So if we look at it, we go, okay, what's our cost? We go November, December, January, February, March, April, May, June. There's 8 months. So it's 8 over 12. So I'm just going to put those numbers in. So 22900 minus 4900 divided by 5. So it's a year, 3,600 divided by 12 multiplied by 8 should give us 2,400. So 8 over 12, 2,400. 400. So that's our depreciation of van. Now, if we go to F, we can record depreciation of vans for year ended in the general journal. So we go 30th June, this is 2025. And we go depreciation of van, and we go accumulated depreciation of van, and we just put our numbers in above. So it's 2,400, 2,400. And G, referring to at least two qualitative characteristics explain the ethical or the ethics considerations of reporting for depreciation. So the first one, I believe, is faithful representation, and the second, oh geez, I can't even spell faithful representation. So when we do faithful representation, we're just going to be talking about what faithful representation is, and from there. And I'd say the other one, especially here, is verifiability. So I think verifiability. So faithful representation is where the business reports the transactions to reflect the reality of the business. In this case, it requires the business to accurately reflect their transactions and decisions that have occurred in the past year. By recording depreciation, it can be seen that faithful representation can be met. On the other hand, faithful representation is hard to achieve with depreciation, as these figures are estimates. For example, the main estimate is the residual value, which is a guess at what the asset could sell for. So you're talking about faithful representation. You say what it is, and then you're moving on to saying how it's met and how it's not met. And the same applies for verifiability. So we'll do verifiability. Verifiability is when the business is able to prove their transactions. Hence, they are verified. In this case, the transaction to purchase the van and its associated costs can be proven and therefore accurately be categorized based on the actions of the business. Now, verifiability is not achieved, again, because we're in that discussion, you've got to talk about both sides a little bit. So you would say verifiability is not achieved as the residual value is an estimate, and there is no real way to see, no real way to create concrete proof that the residual value estimate is accurate. It's because it's an estimate, it's a guess. Now we've got H, last one, H, we're going to get about 25. In July 2025, the delivery driver felt ill, so the van was not used for deliveries for 2 months. Explain whether the van should be depreciated for July and August. Quite simply, the answer is yes. I'll explain why. The van should be depreciated even if it is a straight line method, even if it is not used. This is due to the depreciation method of the asset being treated as a lag, straight line depreciation. This means the asset is depreciated the same amount each month regardless of use. So that's where that all fits in. So my advice to you when answering these questions, make sure you read carefully. Make sure you pick out the key info. Things like insurance should be left separately. Making sure you're reading the months of the year and you're able to calculate, hey, I know between October, including October, and, at the end of October, start of November to the end of June, it's 8 months. Those are all things you need to know. You need to know what to count, and that's stuff like, where was it? C, what prepaid insurance goes under versus what's actually counting as a van. And I think the best way to look at it is this an expense or is it a way to get the item ready to sell? So that stuff like branding as well could be added on. In terms of, in terms of theory, make sure you know your accounting assumptions, make sure you know your qualitative characteristics. I think the big one here, especially in my opinion, is faithful representation. And you want to be talking about how it's all an estimate, essentially. Hard to reflect the reality of of an estimation. And that's why verifiability is such a good answer as well. Because essentially, depreciation is an estimate, and H, make sure you remember that straight line is going to be month on month on month. Doesn't matter how often it's used. If you want to go by based on how it's used, you're probably looking, reality speaking, you're probably looking at your reducing balance, because that can be done based on the amount of use. Anyway, on that note, stay safe, look after yourself and each other, and hopefully, with any short luck, I see you Monday. But if not, this answer is going to be around. If you need help, please let me know. Otherwise, see ya.